All right, let's dive straight into this explainer, because today we are fundamentally shifting how you look at the true cost of your short-term debt. I mean, we all carry them in our pockets, we swipe them without a second thought, and for so many of us, credit cards are just the ultimate symbol of financial convenience. But behind that sleek little piece of plastic lies a financial reality that is deeply misunderstood by millions of people. So today, we're unpacking a really fascinating comparison of Indian borrowing costs. We're going to map out the entire landscape of what it actually costs to access cash when you need it. And I promise you, by the end of our time together today, you are going to view your credit card in a completely different light. Whenever I break down credit card interest for people, this is the exact question I get. It usually hits right after that initial shock wears off. They realize they're caught in a trap, and they're immediately searching for a lifeline. And honestly, it's a totally natural human reaction. You look at the massive cost of revolving credit, you agree that it's obviously way too expensive, but then you just feel stuck. You think, well, look, I needed the money, the card was right there in my wallet, what else was I supposed to do? What else could I possibly borrow at? The truth is, most people simply lack an accurate comparison. They don't know what the current landscape of borrowing costs in India actually looks like, so they just default to the most accessible, yet most punishing option available.
And wow, this is exactly how punishing that default option really is. 42 to 51%, and honestly, sometimes even more. That staggering annual interest rate, which includes GST, by the way, is exactly what you're charged when you default to revolving your credit card debt. And just as a quick reminder, revolving simply means you do nothing but pay the minimum amount due, and you carry the rest of your balance over to the next month. When you do that, you are literally agreeing to pay this astronomical premium. It is incredibly difficult to build wealth or even maintain basic financial stability when you are losing nearly half the value of your borrowed amount to interest every single year. We really need to internalize this number because it serves as our benchmark today. This right here is the financial black hole we are trying to avoid. Okay, Section 1, unlocking your hidden assets, borrowing against what you already own.
So to build our rescue plan, we got to start by swapping out that high-interest trap for some low-interest secured liquidity. By looking at your home, your fixed deposits, life insurance policies, or even gold jewelry, you can unlock immediate cash without falling into that 42% abyss. These are super common assets that millions of Indian households already hold. But the thing is, we often think of these items strictly as long-term investments, right? Or emergency safety nets that shouldn't ever be touched. But in the financial landscape, they are powerful levers. When you face a short-term cash crunch, these assets can serve as collateral. By pledging them, you drastically reduce the risk for the lender. And because of that, the lender drastically reduces the interest rate for you. Let's look at exactly how dramatic that drop can be.
The contrast here is just wild. If you borrow against your own fixed deposit, you're paying a tiny, tiny fraction of the cost of a credit card. A loan against an FD typically costs somewhere between 7.5% and 8.5% per annum. To put that into perspective, the bank is usually only charging you 1% to 2% above the actual rate you're already earning on that very same FD. You are essentially borrowing your own money at a marginal markup. Compare that 8.5% directly to the 42 to 51% you pay to revolve on your credit card. If you have an FD sitting in the bank and you choose to carry a credit card balance instead of borrowing against the FD, well, you're quite literally throwing money away. But FDs aren't the only assets you can leverage. Whether you're using your property for a long-term home top-up loan at around 8.5% to 11%, or maybe taking a loan against an LIC or private insurance policy at 10 to 12%, or even if you pledge gold jewelry to a bank for a gold loan at 12 to 18%, you stay safely under that 18% threshold. Now keep in mind, gold loans from NBFCs might run slightly higher than bank rates, but they are still worlds apart from credit card rates. A top-up loan on your property? Dramatically cheaper. Borrowing against a life insurance policy? Dramatically cheaper. A gold loan? Same story. Every single one of these secured options totally shields you from that exorbitant credit card rate. Moving on to Section 2, unsecured yet affordable options. No collateral? No problem. Now, even if you don't have assets to pledge, no gold, no property, no FDs, there's this fascinating irony in the banking system. An unsecured personal loan from the exact same bank that issued your credit card costs less than half the credit card rate. Depending on your credit profile, a personal loan in India will generally cost you somewhere between 12 and 24% per annum. So let's just say you have an average credit profile, right? And you get a personal loan at 20%. You can walk into the very same institution charging you 42%, sit down and get an unsecured loan for 20%. It requires zero collateral, just like the credit card, yet it cuts your interest burden by more than half. Believe me, the bank is absolutely thrilled when you choose the plastic over the loan.
All right, we're about to hit the absolute floor of borrowing costs. We've gone from 42% down to 20% for personal loans and all the way down to 8% for FD loans. But how on earth is it possible to access short-term cash in a crunch and pay absolutely 0% in interest? Let's take a look. Well, if you work for a large corporate employer, an internally processed salary advance costs you literally 0% in interest. A lot of these large Indian corporations let you take an advance of 1 to 3 months of your salary. Because it's processed internally by your employer and simply deducted from your future paychecks, there are typically no interest charges attached whatsoever. This is undeniably the absolute cheapest possible option for a short-term cash crunch. If you're ever in a tight spot and you have this facility available at your workplace, choosing to revolve your credit card balance instead of just requesting a salary advance is, well, it's a catastrophic financial misstep. Which brings us to Section 3, the ultimate last resort, changing how you view your credit card. So, based on the data we've been looking at, we really need to completely reframe how we view that piece of plastic. When you see the entire borrowing landscape laid out chronologically by cost, starting from the top at 0% and dropping all the way down to 51% plus, it becomes starkly obvious that a dedicated loan product is cheaper than your credit card in virtually every single financial situation. From a 0% salary advance to an 8% FD loan to an 11% home top-up, a 12% insurance loan, an 18% gold loan, and even a 24% personal loan. Every single one of these options sits comfortably above the credit card revolving rate down there at the very bottom. The conclusion is pretty inescapable. If you need short-term cash, the market provides a multitude of dedicated products that are engineered to be vastly more affordable than just swiping your card and walking away. The source material for today's explainer phrases it just perfectly, calling credit card revolving the option of last resort. And I really want you to let those words sink in. Credit card revolving is explicitly priced for desperation. It's not priced for convenience, and it is definitely not priced for casual use. It is meant only for situations where absolutely no other alternatives are accessible to you. It's the financial equivalent of breaking the glass in a dire emergency, like when the salary advance is denied, the FDs don't exist, the gold isn't there, and the personal loan gets rejected. That is literally the only scenario where 42 to 51% interest even begins to make logical sense. So I'll leave you with this question to ponder as we wrap up. Are you treating your credit card as a true last resort, or are you just paying a 42% tax for convenience? If any of the cheaper alternatives we've explored today, the salary advance, the FD loan, the personal loan, if any of those are actually accessible to you, will you step up and use them, or will you just keep treating that 42% option as a harmless convenience? The data is crystal clear, the landscape is mapped out, and the choice of how you fund your next cash crunch is entirely in your hands. Thank you so much for joining me for this explainer, and I highly encourage you to go review your own assets today so you're fully prepared for tomorrow.